Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Australian banks have delivered pretty solid half-year results, with the four major banks reporting almost $17 billion in combined statutory earnings. That's up about 11% on the 2022 half-year results. But there are plenty of headwinds, with rising funding costs, competitive pricing and other things likely to tighten margins. And then there's a recent turmoil out of the US threatening to infect global financial systems. Doug Nixon is the Oceania Banking and Capital Markets lead at EY. Doug, welcome back to Fear and Greed.
Hi, Sean. Great to be here with you today.
So, top line, how is the health of the big four Australian banks?
Thanks, Sean. So Australian Big Four banks have delivered generally positive half-year results, but it is clear that they are facing challenges ahead in an increasingly uncertain and volatile environment. As you noted, statutory earnings for the industry have increased on average 10.8%. Also, net interest margin, or NIM, has increased 17 basis points, and credit provisions increasing by about 4.3%. And that's really all supported by a resilient Australian economy that has continued to provide credit growth and credit quality, while cash rates have helped drive higher revenues and NIM expansion in the half. However, retail credit growth compression is creating highly competitive pricing practices. Funding costs are rising, NIM is under pressure, and inflation continues to challenge the bank's operating costs. So the banks are really walking a tightrope at the moment, and they're going to need to carefully balance capital allocation, pricing, and funding decisions to navigate the market ahead.
Okay, so we might unravel a few of those things. Let's start with the commentary from the CEOs, and not picking on any of them specifically, but generally the three that have reported in the past 10 days or so Westpac, ANZ and National Australia Bank and Commonwealth Bank a few months back, the CEOs have all come out and said, hey, yeah, we had a pretty good time towards the end of last year, but things are going to be much tougher over the next 6 months. Why is that?
It's a great question, Sean. And you remember back to the FY22 4-year results, we saw that was a tale of two halves. That benefit of the rapid increase in the cash rates providing a boost in the second half of FY22. And over the last 6 months, we've certainly seen that trend continue, which is supported in the headline results. However, in the outlook, that competitive pressures, along with market volatility, are really starting to manifest. And that's impacting pricing options, funding costs, and introducing increased uncertainty for the second half of FY23. And so to give you some examples, slow retail credit growth, that's been creating some highly competitive pricing practices. And you've probably heard industry commentators noting pricing of mortgages, for example, below the cost of capital. Funding costs as well, they are rising, and that's amplified not only by the recent dislocation in the financial markets, which you referred to before, but also really competitive behaviours in deposit markets. And a number of institutions noting that resulting pressure on net interest margin and suggesting that NIM may have now peaked. And then last but not least, all important inflationary pressures continue to challenge the bank operating costs, and a number of banks provided details on increasing cost components such as wages, for example, that continue to drive up operating costs for the industry.
Listening to you there, Doug, what are the levers then that the banks have got to pull to actually make things better? If their net interest margin, which is effectively the difference between what they are paying out on deposits and receiving on loans, if they've peaked at least, what are the levers for them to make more money?
Well, there's a few that they have, or there's a plethora that they have, Sean. First of all is looking at the cost base. And most institutions have significant either efficiency or cost takeout programs underway. But the headwind that they face there is inflation and inflationary costs, and they still have ongoing, for example, regulatory and compliance costs. Then there are the market practices that they pursue for their various product lines. When issuing a product in the market, like a new mortgage, how competitively they want to pursue that mortgage, and therefore the yield that they get on that mortgage. And this is that narrative that crept into some of the year-end results presentations about institutions perhaps pulling back from some of the competitive behaviours in retail credit products, for example. And then the other lever, and another lever they have, and I might touch on this one and one more, is where they get their funding from and how they get their funding. And that is one component of that is, for example, retail deposits, and they'll make choices on how competitive that they want to be in retail deposits, i.e., how much interest they will pay when a customer deposits money with them. And then last but not least, and probably most importantly, they'll make decisions on capital allocation and preference for what markets they're competing in, whether it be institutional, retail, business bank, international, so on and so forth. So they've got a number of levers to pull, but it'll be a very careful balancing act for this coming half and in the years ahead.
Okay, just want to ask you to explain something there, Doug. When you talk about they can put capital into retail banking or business banking or institutional banking, the cost of putting that capital into those is actually different. So $10 in a home loan is different to $10 in institutional banking. Is that right?
Yeah, that's right. And because of the competitive behaviours that have been occurring in markets, there has been a return on equity or return on capital compression in, for example, retail credit products, particularly in the retail markets. So because of the pricing practices there, returns have been compressed where they haven't been so compressed elsewhere across the market. For example, in business banking, yields would typically be higher for capital injected into those parts of the business. But Sean, importantly, this is not a magic switch that any one of the institutions can just flick on or off. It takes time to deploy that capital, to pursue market share, to acquire clients, and to build infrastructure to support all the processes. And that's part of the challenge that the institutions will be facing into over the coming years.
Stay with me, Doug. We'll be back in a minute. I'm speaking to Doug Nixon, Oceania Banking and Capital Markets Leader at EY. What about credit quality? That's always a big one when the banks are reporting, and particularly since we are certainly in a slower economy than we were a year or two ago. What are the banks saying on that?
So credit quality still remains surprisingly robust, although we are seeing early signs of deterioration. So in very small components of resi portfolios, for example, a really good indicator of this, Sean, is overall provision levels. And we saw in the results overall provisions for the industry increase about 4.3%, which is indicating that the banks are expecting higher levels of credit impairments in the coming period.
What about what's going on in the US? We have seen some amazing share price moves in single sessions, some of the regional banks, particularly in California, it seems. What sort of contagion effect does that have on local banks? Just park the share price movement. What about the actual operations? Does it matter?
Yeah, it's a really good question, Sean. And it has been fascinating to watch what's unfolded, not only in the US markets, but the contagion effects that we've seen bleeding over into the European markets as well. And I think everyone's been holding their breath a little bit as that unfolds and continues to unfold. But impacts to the Australian financial system to date have been relatively mild. History tells us that tightening cycles do tend to flush out hidden weaknesses in the financial system. And Australia has been a beneficiary of a very conservative approach to capital and liquidity regulation. However, even Australia's well-positioned banks will need to closely monitor and stay ahead of the current environment. Probably the most material impact has come through in costs of funds, and we've certainly seen an increase in that space, bleeding back into, of course, the all-important NIM. But in terms of significant volatility to the Australian banks, it'd be highly unlikely that we'd see anything like the US play out in these markets.
So, to wrap it up, where are Australian banks as we sit here in May 2023 vis-a-vis where they've been in, I'm going to say the last 10 to 15 years, only because that's kind of been a falling interest rate environment. In some ways that has squeezed profitability of banks. Where they sit today, without being specific on any particular bank, does the sector, what's the future look like?
So this set of results represents, I think, a generally good set of results for the industry as a whole. And we've seen improvements over the past 18 months as banks have capitalised on the changing rate environment. But looking through these results, we've seen this consistent messaging that while these results have been generally positive, the industry is entering into a difficult period, a difficult balancing act, that tightrope walk, if you will, while they try and manage all of these factors that are now starting to manifest in competition, in funding costs, and inflationary pressures as they manifest in the industry.
Doug, thank you for talking to Fear and Greed.
Sean, thank you very much for having me.
That was Doug Nixon, Oceania banking and capital markets leader at EY. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.